With markets weighing whether central banks are close to the end of their rate hiking cycle, there's been a growing focus on the potential opportunity in fixed income. For more on that, we're joined now by Scott Colborne, Managing Director for Active Fixed Income at TD Asset Management. Scott, welcome back to the program.
Thanks, Greg.
So this is supposed to be the year, right? We've been talking about this for several months now, but the opportunity in fixed income if certain things happen in the market this year. So how are we set up?
Well, and we anticipate it'd be a reasonably good year for fixed income. I mean, if I could only annualize the last 3 months, though, we'd be even better, right? So over the last 3 months, the markets, broad bond markets, are up about 5 to 7%. So I wouldn't expect that to annualized performance going forward, but you're still talking about very good yields both in the government bond market and the corporate bond market. And as a firm, we've generally liked fixed income for a while here. So we are coming towards the end of the rate cycle, at least in North America and in emerging markets. Europe and Japan, maybe elsewhere, but at the moment we're coming in towards the end of that rate hiking cycle, whether we got one or two more going forward, and then we'll see from there.
Is that really the base condition right now, that indeed we do sort of get that scenario play out where we're expecting, more hikes from our central banks, including our own, but then when they get to that certain point and they're very, I guess the market betting they're very close to that, then we just stay there for a while. Is that the base condition for fixed income to work in our favor this year?
I mean, I think the Governor Powell we talked about pace, and the pace is becoming a dead issue. We're at the end of it. So now it's the destination. At the Fed, the markets are sort of debating between, is it one or two more hikes this year? And then Bank of Canada, it's one hike. And then the question is, as you pose it, is how long are we going to stay there? Really, the markets are saying 6 months. That's it. And within a year, we've got 2 to 3 cuts priced in both Canada and the US. And 2 years out, we've got about 7 or 8 cuts priced in. So there's a lot of forward-looking, the inflation issue by and large for the markets, at least the bond market, is a dead issue. Like, it's come and gone, whether it's the TIPS market, the real return bond market, or the TIPS fixing markets, or the swaps market. Really, inflation is not an issue. So it's the question of growth. Are we going to sort of land in this Goldilocks soft landing where inflation's come down a lot, the central banks step back, start cutting, the labor market softens up, but wages sort of settle in nicely, and off we go, and we have a great risk-on market in the equity market and the credit market. So that's the debate we're having right now, is that transition. How long will we keep at that steady rate hike and before we pivot to any cuts, and what it means for the economic and outlook. And there's definitely a lot of uncertainty on sort of that frame of reference.
I want to ask you what the bond market's telling us about that, because of course you have the central banks working and doing what they're doing pretty aggressively all through last year, and so the front end of the curve perhaps feels a little bit more. As we get further out the yield curve, what is the market telling us about the economy, where they think we're headed in this economy?
When you look at financial indicators, so the yield curve is the obvious one that we've talked about for a long time, is flashing red. It's a leading indicator of a potential for recession. You've got leading economic indicators. They came out this morning, and that also reinforced this. But then you step away and you look at some of the harder data, and it's a little less clear in terms of whether we're flashing red in terms of recession. And this is sort of where I think people are sort of landing in terms of the outlook, at least right now, is, look, it looks like a soft landing, maybe a recession light, but nothing to worry ourselves too much about. And let's put aside, for a variety of reasons, the big yield curve inversion, and we'll move on from that, and central banks will pivot quickly to cutting.
I want to talk about that, right? Because some people are saying, the naysayers who don't believe in that narrative will say, hey, if you get central banks cutting within 6 months or before the end of this year, it's because something has gone horribly wrong in the economy. But as you lay out the pricing that we're seeing in the market action, it seems to suggest that we're going to get those cuts at the end of the year, according to the market, and it's not going to be because we're in a deep recessionary hole. So everyone just mellowed out. I mean, is that a bit of a Goldilocks? I think you might have used the word term Goldilocks earlier.
And that's a tough landing to nail, right? It doesn't happen very much in economic history, and so is this a transitory Goldilocks? Is way of looking at it. That the degree of uncertainty is very high. We've had a lot of uncertainty as we're coming out of the pandemic. Incredible monetary policy and fiscal policy, And we've sort of ripped the bandage off of financial repression, where interest rates were kept low and inflation was high, and that we had negative real yields. Now in the bond market, there are positive real yields on where inflation is going, and with that, it creates a lot of uncertainty in terms of the outlook for economic growth, inflation, the economic growth path around the world, the U.S. dollar. So you sort of ask, where are we going? Are we going to land on that Goldilocks? I doubt it. Is my personal opinion. So I'm keeping our investments sort of very flexible and mindful of the fact that it's going to be a lot is priced in for the good news story of a lot of cuts. I don't think it's going to play out the way that the market thinks, but within financial repression and coming out of this, and now positive real rates and lots of uncertainty, it's going to be a very challenging market to navigate.
Is the market paying enough attention, or perhaps individual retail investors paying enough attention to the other parts of what the central banks have been doing? The headline is always the next rate announcement. Going to be 25? Is it going to be 50? What are they going to do? When they're going to hold there? But what about some of the quantitative tightening outside of just the the overnight rates? Some the pulling back of the bond buying, all that kind of stuff, letting the balance sheet roll off. Is that being factored in enough?
That is continuing, right? The broad drain of liquidity, and that is a headwind for the broad, risk-on markets. I would add to that quantitative tightening, and the ECB is going to step into that as well, is that, you've got other central banks out there stepping into the withdrawal of liquidity in the market. So ECB will be going, and they've got about another 5 to 6 hikes priced into the market. It's been topical over the last couple of weeks, is the Bank of Japan, and I think most observers think that the Bank of Japan will step away from its yield curve control in some fashion, and in fact the bond markets have priced in over the next year or two hikes, and so you've got that broad setback of liquidity, whether it's the Fed or ECB or the Bank of Japan, and that's going to be a headwind against the broad risk on market. And so from an asset allocation point of view, it's going to be choppy and uncertain, and I think that's what investors should take away. I mean, we've had a tremendous rally in the bond market. I don't think this rally continues with the same pace, but I still think it's very attractive. Look, worst case scenario, rates go back up. Given where yields are right now, and given where you lose in terms of prices, your worst case scenario this year is 0. But on the other side, you're either clipping a coupon of between 3 and 5%, which is a great thing, or you've got a little bit of a recession hedge, particularly if you own longer dated bonds. The economy slows down. We do get the Fed and the Bank of Canada cutting, and you've got that insurance by being in long duration government bonds. So I think it's a reasonable place to buy bonds. Maybe not the same return that we've had over the last 3 months, but it's not bad. And I think given the withdrawal of liquidity, whether it's the Fed, ECB, or the BOJ, that is supportive for the fixed income market.